Chapter 4. General Portfolio Policy. The defensive investor Wall Street wants you to believe that investing is a full-time job. They want you to think you need 6 monitors to read the financial news at 5 in the morning and to have a minor heart attack every time a central banker clears their throat. Benjamin Graham, the father of value investing, says, "Nonsense." Welcome to our breakdown of Chapter 4 of The Intelligent Investor. This chapter is a gift to what Graham calls the defensive investor. Now, don't let that word fool you. Defensive doesn't mean scared. It doesn't mean weak. In Graham's world, defensive means passive. It's for the person who wants to protect their hard-earned money and get a decent, satisfactory return, but who absolutely refuses to spend their life staring at charts and worrying about every little market twitch. Today, we're going to build what I call the autopilot portfolio. It's a strategy designed to automatically force you to buy low and sell high, without you ever having to predict, guess, or even think about what the market will do next. This is the Lazy Millionaire's portfolio, and it's brilliant. Let's start with the cornerstone of this entire strategy. Graham gives us a golden rule for how to structure our investments. Our asset allocation. And it is elegantly simple. It's the 50-50th split. Imagine your entire investment portfolio is one big pie. You're going to slice it right down the middle into 2 equal halves. That's it. 50-50. Your portfolio is divided into 2 buckets. Let's call them Bucket A and Bucket B. Bucket A gets 50% of your money. This is your high-grade bonds bucket, or cash and cash equivalents. Think of this as your shield. This is what protects you from severe market crashes, from economic downturns, and from deflation. It's your fortress of stability. When everything else seems to be falling apart, this bucket holds firm. Bucket B gets the other 50%. This is where your common stocks go. Graham suggests focusing on a diversified group of leading companies, what we might call blue chip stocks today, or even simpler, a low-cost stock market index fund. This bucket is your sword. This is the part of your portfolio that fights inflation, that harnesses the long-term growth of the economy, and that actually builds your wealth over time. So, why this specific 50-50th split? Why not 70-30ths or 80-20ths? Because the 50-50th split is an act of humility. It is a direct admission of the most important truth we learned back in Chapter 3. You cannot, and you will not, consistently and accurately predict the future. No one can. By holding 50% in bonds, you are preparing for the worst. If the stock market crashes, if we enter a recession, your bond holdings will cushion the blow and provide stability. You'll be safe. By holding 50% in stocks, you are preparing for the best. If the market goes on a long, powerful bull run, your stocks will capture that growth and make you wealthier. You'll participate in the prosperity. With this simple split, you are structurally prepared for either outcome. You've removed the need to be a prophet. You've accepted that you don't know what's coming, and you've built a portfolio that is robust enough to handle it, whatever it is. Now, we get to the real magic. This next part is the secret sauce. This is the mechanical process that turns this simple portfolio into an intelligent machine that systematically beats the market's psychological traps. It's a concept called rebalancing. Rebalancing is what takes the emotion, the fear, and the greed completely out of the equation. Let's walk through an example. Imagine you start with your perfect 50-50ths portfolio. You have $100,000 invested, $50,000 in a stock index fund and $50,000 in a bond fund. Now, let's say the stock market has an incredible year like it did in 2021. It goes on a massive run. Your $50,000 in stocks grows to, let's say, $70,000. Meanwhile, your bonds stayed pretty stable at $50,000. Now, your total portfolio is worth $120,000. But look at the allocation. You now have $70,000 in stocks and $50,000 in bonds. That's no longer 50-50ths. It's closer to 58% stocks and 42% bonds. What does the average emotional investor do here? They see stocks are hot and they think, let it ride. Maybe I should buy even more. They get greedy, they chase the performance, but what does Benjamin Graham say? He says, stop. You must follow your rule. Your portfolio is now overexposed to risk. You've strayed from your plan. Your sword is too big and your shield is too small. The defensive investor's job is now simple and automatic. You sell just enough of your stocks to bring the allocation back to the 50-50ths target. In this case, your portfolio is 1-2 okay. Half of that is $60K, so you would sell $10,000 worth of your stocks, locking in those profits, and you move that $10,000 over into your bond bucket. Now you have $60,000 in stocks and $60,000 in bonds. You're back to 50/50ths. Let's flip the scenario. The market has a terrible year. It crashes. Your stock holdings drop from $50,000 down to, say, $30,000. Your bonds, being the stable shield, are still worth $50,000. Your total portfolio is now $80,000. What's the allocation? $30,000 in stocks and $50,000 in bonds. That's about 37% stocks and 63% bonds. The average person is panicking. Sell everything. The sky is falling. Fear takes over. But the defensive investor does the opposite. Their rule tells them exactly what to do. They are now underexposed to stocks. Their portfolio is too conservative. To rebalance back to 50/50ths on an $80,000 portfolio, they need $40,000 in each bucket. So they sell $10,000 of their safe bonds and use that money to buy $10,000 worth of stocks, which are now on sale at a huge discount. Do you see what just happened in these two scenarios? In the first one, when stocks were expensive and everyone was greedy, the rebalancing process forced you to sell. You sold high. In the second scenario, when stocks were cheap and everyone was fearful, the process forced you to buy. You bought low. You did this without any market forecasts. You didn't read a single analyst report. You didn't have an opinion on interest rates. You just followed the simple, unemotional math of your rebalancing rule. This is the genius of Graham's approach. It automates intelligent behavior. Now, Graham does offer a little flexibility. He says you don't have to be dogmatic about a perfect 50/50th split at all times. He suggests that the defensive investor can allow their allocation to drift within a certain range. For example, you could let your stocks fall to as low as 25% or rise to as high as 75% of your total portfolio. If you feel you have some insight into market valuations, for instance, if you believe stocks are outrageously expensive, you might choose to deliberately shift your allocation towards the more conservative end, maybe holding 75% in bonds and only 25% in stocks. Conversely, if you believe the market has crashed and stocks are incredibly cheap, you could shift to 75% stocks and 25% bonds. However, Graham offers a stern warning here. This is a slippery slope. For most people, especially those who want a truly passive, low-effort strategy, the simple 50/50th split with periodic rebalancing, say, once or twice a year, is the safest and most effective path. The main point is to have a rule and stick to it, preventing your emotions from making costly decisions. This strategy is not about getting rich overnight. It's about building wealth steadily, safely, and sanely over a lifetime. It's about sleeping well at night, knowing that your portfolio is prepared for whatever comes its way. You don't have to be a Wall Street genius. You just have to be disciplined. So the next time you see someone frantically watching the market, remember the wisdom of the defensive investor. Just stick to your 50/50ths plan. Rebalance periodically and let the system do the hard work for you. You'll likely end up ahead of most of them, and with a lot less stress. Now, Graham does allow some flexibility here. He calls it the slider. Think of it like a volume knob for your risk. He says you can slide that 50/50ths rule depending on how dangerous the market feels. During times of maximum fear, when you feel the market is dangerously high, like the bubble just before the 1929 crash or the dot-com bust in 1999, you can slide your allocation down to just 25% in stocks and a whopping 75% in bonds. This is your storm shelter. You're battening down the hatches, protecting your capital from a potential crash. On the flip side, during times of maximum greed, when everyone else is panicking and the market is basically on a fire sale, like in the depths of 2009, you can slide the other way. You can go up to 75% in stocks and just 25% in bonds. This is when you're being brave, buying quality companies when they are incredibly cheap. However, Graham gives us a huge warning here. Most people are absolutely terrible at judging this. Our human emotions get in the way. We tend to do the exact opposite of what we should. We get caught up in the hype and buy 100% stocks at the very top, and then we panic and sell everything at the absolute bottom, locking in our losses. So, unless you have nerves of steel and the emotional discipline of a Vulcan, Graham's advice is simple. Just stick to the 50/50ths rule. It is a beautifully simple system designed to protect you from your worst enemy in investing, yourself. It forces you to buy low and sell high without even thinking about it. Now let's talk about modernizing this for today. A big question is, what do we do with that bond bucket? Back in Graham's day, bonds were a great deal. They paid a reliable 5% or 6% interest. It was a no-brainer. But today, the bond market is, well, it's a bit weird, isn't it? Interest rates have been all over the place. So how do we apply this principle now in the 21st century? The key is to remember the function of this bucket, not necessarily the specific investment. The goal of this half of your portfolio is safety and stability. For the safe bucket, the modern defensive investor has a few great options. First, you have high-yield savings accounts. These are completely safe, FDIC insured up to the limit, and right now they're actually paying pretty decent interest. It's basically digital cash that earns you money. No risk, easy access. Second, you could use short-term treasuries, often through ETFs like SHV or SGOV. These are funds that hold very short-term government debt. They're considered one of the safest investments on the planet, basically cash that pays you a bit of interest. The price barely moves, so it's incredibly stable. Third, you could use a total bond market ETF, something like BND. This gives you a slice of the entire US bond market, government bonds, corporate bonds all mixed together. It's more diversified than just one type of bond. Ultimately, the specific vehicle you choose doesn't matter as much as its function. This money must be stable. It is the anchor that stops your financial ship from drifting away and crashing onto the rocks during a market storm. All right, now it's time to put this into practice. Let's do a quick autopilot audit. This is your action plan. Step 1. Log into your brokerage account right now. Go on, I'll wait. Take a look at your current allocation. What's the split? Are you 90% in stocks and 10% in cash? Maybe even more? You might be taking on a lot more risk than you realize. You're essentially driving a race car without a seatbelt. Step 2. Decide on your ratio. Are you going to be a pure, classic Graham 50/50th investor? Or maybe you're younger, you have a longer time horizon, and you feel comfortable being a bit more aggressive. Perhaps a 70% stock, 30% safe bucket split is right for you. Step 3. And this is the magic key that makes it all work. Set a calendar reminder on your phone or computer. Label it Rebalance Portfolio. Set it to repeat once every 6 months, or at the very least, once a year. On that day, you log in, look at your ratio, and adjust it back to your target. If stocks had a great run and are now 60% of your portfolio, you sell some and buy more of your safe assets to get back to 50/50ths. If stocks crashed, you sell some of your safe assets to buy more stocks on sale. And that's it. Seriously, that is it. You look at your portfolio maybe twice a year. The rest of the time, you sleep. You work, you go on vacation, you spend time with your family. You enjoy your life. That is the incredible luxury of being a defensive investor. You're not glued to the screen, you're not stressing about every headline. You have a system and you let the system do the work for you. Thanks for watching. If this helped you simplify your investing strategy, make sure to like and subscribe for more content that cuts through the noise. See you in the next video.